U.S. natural gas futures remained below the $3 level this week, the lowest level in 5 months, reflecting falling prices at major hubs in Europe and Asia amid ample global supply and uncertain demand driven by macroeconomic challenges. New data showed that domestic gas output in the United States averaged a record 106.6 billion cubic feet per day so far in April. This surge in production coincided with warmer than normal temperatures, expected to continue through early May, reducing heating demand as northern states transition out of the winter season. Consequently, EIA data indicated that gas storage levels rose by 88 billion cubic feet last week, well above the forecast of 65 BCF and marking the largest weekly build of the injection season. Additionally, today's storage projections turned even more bearish. The expected surplus for May 9 increased from 25 to 60 BCF, while the May 16 forecast now shows a substantial 99 BCF surplus. Overall, market conditions are becoming increasingly bearish. Meanwhile, global demand remains under pressure, with China's LNG imports falling 20% from the previous month amid trade tensions with the US, and India reducing LNG consumption due to declining coal prices. Prices are now pressing against key support at $2.90, the level currently steering the broader trend, and the risks are firmly tilted to the downside. The real question is, how long can the bulls hold the line before we tumble toward $2.50? Still, I wouldn't rule out a quick bounce toward $3, likely driven by short covering, before any deeper breakdown. Watch $2.86 closely. If that gives way, we're not just talking about a slide to $2.50, but potentially a sharper correction down to $2.20. If you think I'm off the mark, don't hesitate to let me know in the comments. Please listen to the podcast discussing the price and production outlook through 2026 and why volatility may be here to stay. Please like, subscribe, and comment to support the channel.
This is going to be a real fundamentals-heavy conversation, and I love having people on that are smarter than me and know more than me, because sometimes I can be bad with rattling off numbers, and there's a lot going on in the gas market right now, where people are starting to hone in on summer demand and the next heating season. And I think people have said we had an earlier than expected start to the injection season. Some of the estimates are a little wonky right now. So what do you think is going on in terms of storage and production?
Yeah, injections the week ending March 14th and kind of continuing, probably going to be a net injection March, right? Which is fairly uncommon. The early start basically puts us about 100 BCF ahead before formal injection season starts, right? But I would say that 100 BCF extra that's in the ground right now is going to be needed. You've got 214 days of summer, right? And you've seen elevated power demand in the past. Certainly, the forecast I've seen are for above normal heat conditions this summer, which could very well suck that up. So the 100 BCF or so is a good head start, but I don't know that it's going to to last, to be able to keep things oversupplied for the duration.
Right. So I remember in 2024, maybe around the summer to the fall, I recall hearing you talk on a presentation calling for stronger prices in 2025, and I think East Daily was one of the first groups I heard ringing that bell, and at this point it looks like it's come true. And I remember you telling a group of LDCs that they should be looking at tighter supply balances right now and locking in supply. So like what is going on? Like what has played out with that forecast at the beginning of this year?
Just not to pat ourselves on the back too much, but it did turn out to be true. Back in January of 2024, we were actually 40 cents above the curve for Cal 25. Right. So, since that time, it took about a year until Jan 25 for the market to, kind of catch up to where we were. Right. So you had pretty much all of 24, if you were a consumer, to really lock in lower prices. I'm not sure how many folks really took advantage of that. Certainly, if you're a merchant utility, it would have behooved you to do that then. Maybe some large industrials, that sort of thing. And the utilities, right? If you're a regulated utility, maybe you're not as motivated to, to buy on the forward curve, because you can always go through a fuel cost adjustment case with your PUC. But it certainly would have done your constituents a favor if you had.
Yeah, I heard something similar talking to some storage developers not too long ago, where they were saying the numbers are all here. There's a crunch on storage capacity, but people aren't necessarily interested in buying in right now.
Yes, there is. So, I've been talking to some developers as well, and they've got a lot of interest, right? In their open seasons, whether binding or non-binding, the interest is there. The consternation about paying up for a scarce kind of service, right? I think it's reasonable, but it's not going to go away. Fact of the matter is that storage deliverability as a percentage of demand is rapidly eroding, right? If you're an LNG exporter and a hurricane runs through Port Arthur and your facility is shut down for 10 days, what are you going to do with all the gas you've committed to, right? Same thing if you're a utility or, and you can't, there's a net demand destruction event. You don't really have any, for lack of a better word, there's not really a safe haven or a port to dump all that gas into.
Right. And so, I mean, looking at price forecast for this year, I've been interested, like over the past 2 weeks, everyone that's come out with their forecast update has revised up their numbers. EIA's short-term energy outlook, JP Morgan, Bank of America, they've all went up maybe 20 to 30 cents. And most of them have average Henry Hub this year could be around 420 to the mid $4 range. What does East Daly's outlook look like stacked up against that?
So we're 438 for the summer, right? And winter 25-26, we're actually at 467. So we're a little lower than the curve going into winter. Calendar year 25, we're 441, right? But we think that changes a little bit heading into winter 25-26, and the reason for that is production, right? We're betting on the Haynesville. We're betting that if you're sitting at about 105 BCF a day of production right now, you can get to 106 pretty easily, and we've done that in the past. We saw it in December of 23 and January of 24, so it's not unachievable. And then you kind of march forward into Q4 25, approaching 108 because the demand is there. But we believe a healthy production response will keep a little bit of a governor on prices on average for winter 25-26. Now, there will be months, right? So decent Jan and possibly Feb could be above $5. But on average, about 467 is where we're at.
Gotcha. And I've read before that East Daly's called 2026 prices oversold at this point. I not to date this podcast too much, but I looked at our forward look average prices for summer from NGI. So I mean, these are just extrapolations of trades, but those are cresting over $4, and then winter is looking above $5 at this point, and then those start to roll off in 2026. So you think production will respond at that point?
Yes. It's going to come from kind of a variety of players, right? I guess over the past couple of weeks, we penned an insight piece that basically kind of pegged Haynesville producers as playing a game of rigged chicken. which is it's a funny play on words, but really what it is who's going to flinch first, right? Expand has come out saying, all right, we're gonna boost rigs by about 4. Sabine, which is a much smaller player, is going to increase by 1. If that's indicative of maybe what TG and Comstock and some of the others are going to do, we could easily add 10 rigs in the Haynesville this year in total. And that's not ignoring or making light of Aethon's stance, right? They're striking a more conservative chord, I think, because that if indeed they are going to get acquired this year, right? Let's be fiscally responsible, right? Let's kind of keep our best acreage in hand. Perhaps prices will sustain at that $5 level, and that'll be attractive to a potential buyer.
Mm-hmm. And so I want to dig more into that, but I want to get maybe back to the demand side before I lose the thread, because I can be forgetful. Looking at all of these revisions on these forecasts, I mean, there's been a lot of chatter about the rate of ramp up for Plaquemines LNG. They've been pushing those trains above capacity and taking them online sooner than some people thought. And then Corpus Christi stage 3 expansion jumped up. But do you think people weren't expecting those ramp ups, or it was more of the lagging production that has kind of skewed some of the forecasts?
Plaquemines is an interesting case. I think it came on a little faster than folks expected, right? We're seeing 16 of 18 trains in operation right now, and flows that are really above capacity, bumping up above, near 2 BCF a day, right? So they're really taking advantage of the capacity they've got, on that CGT East Lateral, that new infrastructure piece from Gillis, and then Evangeline Pass as well. So they've, the gas can get there, and they're using it, right? So that's been a big development. For Corpus, because it's on an intrastate, that 80cc line. We can see we have to use satellite data to see if there are heat signatures on the individual trains, and we've seen, obviously, train 1 has been going off since about late December. We expect to see train 2 light up here soon. Hopefully they gave guidance that it would be online before like June. So we're looking for that. That'll be another 0.2 BCF a day of, kind of, call it commissioning demand or cooling demand, coolant demand. And so, those are just additive, right? For calendar year 2025, we're looking at a bump in total LNG export demand of 2.8 BCF a day. And so, that bleeds into our storage situation. It certainly prompts production. I do think that there could be an instance here where production is front running a little bit, and we just can't see it. So that I know, long answer to a short question, but the past 2 storage reports have been a little heavy on the injection side, right? By call it half a BCF a day or so, and that could be the result of some what I termed yesterday some secret production. Perhaps coming out of Haynesville or East Texas, and just dumping into South Central non-salts. So I think there's a little bit more supply out there than the market maybe knows about, but there's also quite a bit of demand that's only going to increase as we get warmer here.
Right. I've also been trying to put my thumb on what it means. Maybe this is a hyper-regional impact, but Calcasieu Pass is about to be producing regular cargoes for its contract holders, and it's been making spot cargoes since it started commissioning 3-something years ago. But that's largely determined on the equipment they're testing and what spot demand is like. But in February, when they only had 4 of their heat steam recovery generators working, that the receipt point had about 50% of capacity for nominations. When I checked yesterday, right after FERC had approved their final full restart, it was about 80%. So they're pulling in more gas consistently. And maybe some people have that's dropped off their radar, like they just assume that's a known quantity that's working. But
yeah, I mean, it could very well be priced in, but the bottom line is that that's more gas leaving the grid, right? And when you see that day after day after day, along with elevated power demand, it's going to make an impact. So the pace of injections this summer is going to be an important thing to monitor. So our base case is that we end October, and just using normal weather, we get to like a modest surplus to the 5-year average of about 34 BCF a day. However, if we were to inject like we did last summer, when it was pretty dang hot, the hottest meteorological summer in the lower 48 ever, there's potential for storage to end at a deficit exceeding 350 BCF, which would be pretty wild. Obviously, very bullish. That kind of secures your 5 handle going into winter. But my bias, I guess, is with the weather outlook, with elevated power demand, data centers coming online, and this LNG persistent kind of non-intermittent ramp. The demand side is going to be very robust.
I mean, I do recall an EIA analysis not that long ago talking about how 2024 was a record year for gas-fired generation, and that was industrial consumption, but also the need for like intermittent generation during peak demand, lots of storms and summer heat. So that's probably not going to go away, as I say from Texas. But
right,
so you mentioned Atheon earlier, and they had some interesting comments in their last call with analysts, where they were saying we don't need sustained prices this year. We don't need them next year. We need them for the next 3 years if we want to make these strategies work. How common do you think that refrain is amongst a lot of the EMPs?
I'm trying to figure out a way to phrase it. I think it's kind of it's the power of positivity. Let's just call it that. Sure, we'd all, if you're a producer, right, you'd love to see sustained prices above $5. That's great for your bottom line, especially when we estimate break even costs in the core of Haynesville at 240. Right, so you double your money there, right? Even emerging like West Haynesville stuff, that break even is around 375. So, both of those are easily in the money right now for most producers. But I think too, from a sustainability perspective, if you want to have positive free cash flow and be fiscally prudent and responsible, yes, $5 would be preferable for most.
Mm-hmm. And so, if and when producers bite on these prices, I think you've outlined that you think Haynesville is where we're going to see it first, and you've been monitoring some consolidation or possibly some asset buying already at this point.
Yes. So that Citadel Paloma deal was very interesting, right? Paloma only spits out about 400 million cubic feet a day, but a hedge fund, kind of directly getting physical, I think should send a message to the market. They're going to want a more immediate return on their investment, maybe than more of a long-term player. And so they're reading the tea leaves. They're looking at the 5 handles in winter 25, 26, and they're ready to kind of pounce on their market share, right? So that's an interesting deal. TG bought some acreage interest from Chevron. They're firmly embedded in the field, right? They've got transportation all the way down to the Gulf Coast on some of the new infrastructure pipes. So people are really digging Haynesville. I don't think they want to exploit it, but they want to farm it. It's a very fertile basin, and let's farm it, right?
I mean, and during the height of the height of the drop, that's an oxymoron. But when gas prices are really low, we kept hearing about how Haynesville's so flexible. It can bounce back so easily once these prices start ramping up. So if you own acreage there, I guess it makes it a better flexible investment.
Yeah. Yep. Especially for somebody like Tokyo Gas, right? I mean, they're a natural long, a natural short, just in terms of consumption in Japan, and this is a great way to uh, source some of the lowest cost gas in the world, right? Um, so yeah, surety of supply and flexibility are big positives.
And have you taken any look about what's happening with the Permian and the chance of added gas from there this year? Because I mean, we've been monitoring. We've got a story about people being surprised by this growing price gap between Houston Ship Channel and Henry Hub so soon after Matterhorn came online. And so, I mean, is that capacity already taken up?
I believe so. The flows that we can see are about 1.6 BCF a day out of the, let's call it 2 BCF a day that it can, that it probably is running. There's some intrastate activity that we can really only see on the GNP side. And so when we update our models in a month, we'll be able to see, like of the capacity holders on Matterhorn, whose GNP systems, are basically, running at full tilt. Now there is also about 0.5 BCF a day of incremental capacity that can be laid out there through compression improvements, that sort of thing that we believe will be online by July. But you can see from Waha basis getting crushed with just like routine spring maintenance, that Permian is once again heading into constraints. One thing I would be concerned about is what's like, I think I read that November crude futures are like nearly below 60, right? To what extent that discourage E&Ps from following through on their drilling plans this year for crude, right? And then the impact on associated gas. So yeah, it's a tenable situation. We still have gas production up there by about 2 BCF a day this year, but that's basically taking advantage utilization of full full egress capacity to the west, to refill Pacific level storage, and then full capacity going to the east as well, in addition to sourcing cheap gas to go northeast into the mid-con, and take advantage of some of the where there is capacity existing. So yeah, and that 2 BCF day was pre tariff crude price collapse.
Right.
So it's definitely a situation worth watching.
Yeah, I mean, to date this podcast some more, we're a day out from quote unquote Liberation Day, so we're still seeing what's happening with oil.
It's a very fluid situation, if you will.
Yeah, exactly.
God, that was a terrible bad joke.
I enjoyed that. No, it's so in jumping regions again, I know we're going east to west back on the map, but I wanted to give us some time to talk about this, something I'm really interested in. EIA said that, along with their revisions, that looking further into the year into 2026, that the ramp up of Plaquemines Phase 2 and then Golden Pass Train 1 in early 2026 is causing some fog around like what the upside of the forecast could be. So I know you've already touched on your guys' thoughts on the production outlook. Do you think there's chances we could get more of these short-term supply squeezes?
For sure. Within a tight market, right, there's definitely going to be more volatility, more pops, right? A weather forecast, changes, and all of a sudden you've got, algo traders rushing into the market, pushing things up for the prompt or whatever. Cash will be more volatile around the hub. One positive development for call it the east side of Port Arthur, right, with Golden Pass coming online, and some of the other demand centers down there, is that there is availability of supply and there is infrastructure that will be in place by the end of 2025. So with both Williams Louisiana Energy Gateway and Momentum's NG3 pipeline coming online this year, you've got a lot of flexibility to deliver into Gillis and Starks, Louisiana, those marketplaces. Golden Pass shouldn't have a lot of trouble sourcing supply. The pace at which Golden Pass comes online certainly makes things a little fuzzy. Plaquemines, we think, if they've perfected the turn-on process for their first 18 trains and they start working on those second 18 trains in 26, that could be a pretty steady ramp that you can, you can ease into, you can step into. But yeah, just general tight market conditions will make things a little rocky. But on average, and that's what we forecast. On average, we've got 2026 pegged at about 426, roughly 16 cents below the current forward curve. And we think that's a pretty reasonable assumption because there is going to be 108 to 110 BCF a day of production that can leg into this demand conundrum.
Yeah, well, to dust off an old gem, the cure for high prices is high prices, and I feel like that can sometimes work in reverse as well. So
yeah. I'm looking at that. If XLE is, that sector is getting crushed right now, right? Might be a good time to buy. Ahead of more bountiful opportunity in the future.
Yeah. And I I always enjoy when you tell LDCs that you should be looking at your expiration dates on your contracts and you should be locking them in.
Well, hey, I'm on the board of Energy Outreach of Colorado for a reason, right? We advocate for income qualified folks. We do not like fuel cost adjustments because it's easily solvable, right? Just pay attention to where the market is going and buy when gas is cheap. You should never be buying on the spot in winter. So anyway, that's my own personal gripe. But I'm not a regulated utility, so I've not walked a mile in those shoes. I don't know how hard it is, but I also don't have a lot of sympathy either.
Thank you again for joining me today, Jack. It was a great chat.
Yes, awesome discussion. Thank you, Jacob.